My name is Chris Thomas. My firm is 40W Advisors, and we have the privilege to serve as the retirement plan consultants on your company's 401k plan. As a part of that service, what we do is we provide education to all of the employees like yourself. And we also, in addition to helping the company monitor the investments and monitor things related to the 401k plan. So this month's webinar, which we do every month, it's typically the second or third Thursday of every month, we tackle a different investment topic. At the end of each quarter, since today is the beginning of the first quarter, or January is the first month of the first quarter 2026, we always tackle an investment topic, taking a look at the investment markets, looking backwards. And this year, for this session, we'll take a look at 2026, looking at the investment markets going forward. I am joined today by Micah Potashnik, my colleague. Hello, Micah.
Morning, Chris.
Good, audio is working. That's a good sign. Before we jump in, I just want a couple of compliance administrative notes. First of all, everybody's currently entered in listen-only mode. If you do have any questions, please use the questions box, the questions feature that is on the meeting control panel. Try to monitor those as we go through the presentation today. Secondly, everything we talk about today is for information and educational purposes only. Nothing we talk about should be considered to be personal advice to your specific situation. If you do have questions about your specific situation, we encourage you to reach out to us and talk one-on-one to answer any questions that you might have that are specific to you. So with that out of the way, let's go ahead and jump in. We're going to take a quick look at market performance. We're going to talk about why things happened the way they did. We'll kind of weave in some historical context and talk to you about some different ways to approach your own investing. So that's the way that we're going to tackle things today. So let's just start with the scoreboard. If you've joined us before, you know that we always like to start, with the scoreboard of what happened before we dive into the details and the stories. So as you can see, 2025 was another great year for investors across the board. Here we've highlighted just a few of the major asset classes, starting with US stocks on the left. The S&P 500, which is comprised of the largest 500 publicly traded US-based companies, was up almost 18% on the year. It's been up 8 out of the last 10 years and up double digits in each of those years. We're going to talk about more of that in a bit. Stocks of smaller US-based companies were also up double digits for the year. Those are measured by the Russell 2000 here. Once again, however, small cap stocks trailed international stocks or larger US stocks, which is kind of a trend that we've seen over the last few years. Bottom line is these smaller US stocks just don't have exposure to those large AI heavy hitters that have really been carrying the S&P 500. Moving on to international stocks. One of the most notable changes in 2025 was the comeback of international stocks versus US stocks. As you can see, both international stocks in developed markets like Europe and Japan outperformed the US, as did emerging market stocks. Emerging market stocks are made up of China, a lot of Southeast Asia, and some emerging economies in Latin America and Europe as well. Both up over 13% above the US. So that's something we're gonna circle back to that in a little bit as well. Bonds were up a little over 7% in 2025. Bonds, typically the conservative part of portfolios, had a positive year. And they had a positive year because interest rates were at a little bit of a higher level, which helped, and then they got some additional support along the way. We know that a lot of people online here, all participants in a 401k plan, a lot of you are invested probably in the target date funds of your plan. Therefore, we like to show kind of a sampling of what target date fund returns might have looked like for last year. So here you can see a 2030 target date fund up mid-teens, 16%, and those longer dated target date funds for maybe younger folks with a longer runway to retirement, up almost 20%. So a positive year across the board for savers and investors. Mike, anything to add on performance there?
No, it's, again, as you said, a great year across the board, and it's good to see international stocks, and we'll talk more about it. Also provide a little bit of return there as well.
Yeah, and hopefully you all have seen that in your 401k accounts if you've logged into your accounts recently. So the data that we just show, the data shows us that a majority of people on the line are probably invested in the target date funds that are available in your 401k plan, which is great. It's an easy way to make sure that you are diversified with your investments. Target date funds are professionally managed portfolios. They diversify your savings into different types of investments based upon your time horizon until retirement. As a reminder, here's how they work. Someone currently age 30, planning to retire at age 65, might choose the 2060 retirement portfolio, 2060 being the target year for retirement. Since they're 35 years away from retirement, they can take more risk with their investments. So the 2060 funds is going to be invested almost entirely in stocks or equities, which have historically generated higher highs, but also have experienced some more volatility and some lower lows. And we're going to take a look at that in a little bit. Now, as you get closer to retirement, your appetite for risk tends to decline a little bit. So target date portfolios start to automatically shift more into bonds or fixed income investments, which historically have shown less fluctuations in their price and in their value. Lower lows, I guess you could say. And again, we're going to take a look at that more. But because target date funds are so prevalent and so popular within 401k plans, we always like to circle back and just remind people of exactly kind of how they work. So now let's kind of dive a little bit deeper into US stocks and just talk about kind of what happened last year. And we're going to do this just before we kind of turn the page and look towards 2026. It's worth kind of just reflecting on really very simply it was an eventful year, but for US stocks, and you can see it was kind of a tale of two halves. The year began with the stock market hitting new highs in February, but then we saw a sharp reversal due to the trade policies and tariffs that triggered nearly a 20% sell-off. But that sell-off set the stage for one of the strongest recoveries in decades. It was fueled primarily by AI, rate cut expectations, strong corporate earnings, and resilient economic growth. And we're going to talk more about those components, earnings and the economy in a minute, as we kind of set the foundation for looking forward to 2026. That being said, the S&P 500 set more than 35 new highs throughout the year end. And finished, like we said, about 18% higher for the year. It was a third consecutive year of double-digit gains, which has been a really impressive run. If you think back over that time period, we've had a global pandemic and we've had some pretty aggressive rate hikes from the Federal Reserve, and we've also had, obviously, the rise of AI, which has really catapulted markets here recently. Micah, jump in anytime you have anything to add here. I know.
Yeah, I would say one thing, just kind of interesting in 2025, that the month of May, one of the best months of the year, was very closely followed by the worst months of the year in March and April. And a lot of times in investing, that's a common theme, that a lot of times, sometimes the best returns, the best days of return, often follow some of the worst days. We go back into the beginning of April. From April 2nd to April 8th, the market was down about 15% in just 3 or 4 trading days. April 9th happened, and we had one of the best days in market history. And so it's the emphasizing the importance of staying invested. That's why having thinking about the time horizon of your investments. That's why these target date funds are so important. Is that it keeps you in the game, so you don't miss out on those quick rebounds, and it doesn't put you in a position to react where when things can get scary after a few down days in a row.
Yeah, and that's one of the threads throughout this presentation, and that's really the lesson to take away from this today, is that reacting emotionally with your investments is often never the right course. And we like to highlight that. There's all kinds of data and charts that we can show, but I think, to Micah's point, looking at it in real time for things that just happened while they're fresh in our memory is really helpful. So we just saw what happened in the first part of the year. You all remember the tariff announcements, and the markets reacted pretty expeditiously to the downside, but to Micah's point, rebounded very quickly. And if you were to have overreacted, you would have missed out on that. So I also want to look at the same, kind of tell the same story, looking at the end of the year, just what happened in the fourth quarter, just recently in our rearview mirror. And what I want to talk about here is just really emphasizing that point of market resiliency, because it's an important concept for investors to understand and embrace. Throughout the year, we got calls from clients and 401k participants like yourself, kind of worried about just the prevailing uncertainty that was around, afraid that the stock market crash was just around the corner. And with each of these discussions, we really had to peel back emotions from reality. So if we do zoom in at the fourth quarter of last year, we can see that there were a lot of headlines, good and bad. We started with the longest government shutdown in history. The very fact that the government of the world's largest economy shut down and the stock market barely blinked tells you that the market rarely behaves the way that the rational mind might think. We also, shortly after the shutdown, we also saw that the Trump administration also threatened new tariffs. These tariffs were the very same thing that caused that near 20% drop in April, but yet nothing happened in October when those new threats were made. So the bottom line is there's always headlines, there's always reasons to worry, but the market oftentimes does not react the way that you think. But what I want to kind of focus on here are a couple of things that happened later in the quarter. First, I want to look at this November 21st and just point out that NVIDIA, which is now a household name, one of the largest companies in the country, announced record earnings, almost 100% growth in profits from a year ago. The point is emphasizing earnings. Earnings are what matter most to the stock market. The price that investors are willing to pay to own a stock is going to go up if they believe that the earnings of that company will increase. And specifically, they're going to increase into the future. So the stock market's always looking forward to the future. So let's put a pin on earnings for a second. I'm going to come back to that. The next thing I want to highlight are two economic data releases that happened at the end of the year. The first was the unemployment rate. The unemployment rate's just the percentage of people that are looking for a job that can't get one. It ticked up in December to a 4-year high. It actually has come back down a little bit since then, but directionally it's been creeping up a little bit. The labor market is definitely slowing down. It's not yet in a troubling spot, but it's something that we're going to be watching in 2026. The ability for us, for for us to be employed and to have growing earnings is really fundamental to a strong economy, and a strong economy is fundamental to the stock market. The other economic data release was the GDP. This is a more positive release. The GDP was up 4.3%. It's the highest growth since Q3 2023. And what GDP is it's just a measure of the overall economy more. It's more or less how much people and businesses are buying. So the GDP print was a good sign. It was a sign that the economy is in a good place. And again, the reason why the economic conversation is important is because the economy is what creates the opportunity for businesses to make profits. If people are employed, if their earnings are growing, then they will spend. So a strong economy is fundamental to stock market growth. And that's why, looking forward into 2026, we're going to talk about some of the things related to the economy. So I already mentioned that large U.S. stocks have double-digit returns in 8 of the last 10 years. But we're in the midst, for sure, of a historic run for stocks, which leads many to believe that maybe is this a pullback? Are we due for a pullback? Are we due for a correction? Are we due for a crash? Are we due to the bubble bursting? Whatever word you choose is kind of a good indication of just how emotional you kind of feel about your investments, and it's okay to feel emotional about your investments. It's very normal. But this chart here is one of my favorite charts to show people because it helps kind of put things into context. The first thing to notice is that U.S. stocks have been up 35 out of the last 46 years. So that's over 70% of the time, US stocks, this is the S&P 500, over 70% of the time, 70% of the years, US stocks are up, S&P 500's up. The second thing, which isn't really explicit on this chart here, is just that the average annual return is between 11 and 12% during this year. So you've averaged, if you stayed invested throughout this period, you would have averaged about an 11 to 12% return per year. But you'll notice that when you look at the annual returns, they're very rarely right at the 11 or 12% mark. Only a few years are they. You typically get what we've experienced the last few years. You get growth much higher than that, and then you're going to have some years, those years where the market's down. So it's rarely right at the 11 to 12%. The third, and kind of probably the most important thing that I want to take away, is that these gains that we get 70% of the time, they don't come in a straight line. The red dots here show you how much the market has dropped within a given year. So, it hits a peak, and then it falls, and then it comes back up again, kind of like the chart showed, exactly like the chart showed in April. So what you can see is, on average, we see about a 14% drop within a year. So you can just look at last year. We just looked at it. We had that 19% drop in April, yet the market finished up 17, 18%. It's been the same if you look back. There's always, every year, the majority of years, you have periods where the market pulls back within the year. People get a little bit worried that it's going to be a precipitous drop, but inevitably the market in at least 70% of the years has rebounded and finished positive.
One thing too, Chris, just to add to all that is, you said sort of volatility is the price of admission, right? Like, to get 10 to 12% return each and every year, it's not going to be a smooth ride, or else everyone would be able to put all their money in the market and just leave it alone and things like that. That's why it's important to stay diversified and have different sort of time horizons on dollars, and that as your time horizon increases, you can afford to put more money in the market and sort of let the market do its thing and be able to deal with the ebbs and flows. And that's where this chart is so powerful, that despite all these downturns each and every year, over a long period of time, the market generally shows positive returns, and not just single-digit positive returns, but even at times double-digit positive returns as well.
Right. S&P 500 is a very resilient market. So wanted to just make that point there. Let's shift gears to international stocks now. One of the 2025 kind of defining themes was the outperformance of international stocks over US stocks. This slide shows the annual return, the price return gap between international and US stocks going back to 2006. So the positive values, that just indicates how much the international stocks outperformed, while the negative values show that the international stocks underperformed the US. So as you can see, last year, international stocks outperformed the US by 13%. It's really, the reason why it was really one of the defining themes is that, as you can see, there's only been 4 years in the last 16 years that international stocks have outperformed US. So if you go back to the 2010 to 2014, you can see where there was a pretty dramatic underperformance there. So the reason for this, it's not because of, it's really not because of anything having to do with the US weakness. The US economy, coming out of 2008 financial crisis, the US economy just grew at a stronger pace compared to regions like Europe. International stocks have also underperformed because the international indices just have very limited exposure to technology companies like NVIDIA, Amazon, Microsoft. There's not a lot of technology companies domiciled in Europe in some of the international countries. And as we know, those AI stocks and the AI industry as a whole have really been carrying the entire market for a while now. The third thing is that the US dollar for a long time was strengthening against foreign currencies. So what we've seen though is those funds kind of reverse course. So what led to US international markets outperforming last year was, one, we saw a shift in the US trade policy. We saw that with tariffs. Tariffs kind of ushered in a little bit of de-globalization. So now companies other countries are starting to have to build their own domestic infrastructure, build their own domestic economies rather than outsourcing everything. So that was a positive. We saw a weaker US dollar. There's concerns about the US debt levels being one of the reasons why the US dollar declined. That's stimulative and that has a positive impact on international investment prices. And we also saw, as part of that kind of building up domestic economies and domestic infrastructure was an economic stimulus, particularly within Europe, where you saw deregulation and you saw some increased defense spending. One of the things that the Trump administration did really during their first term, but put an emphasis on now, is having Europe contribute more towards the NATO defense budget. And that's having to build some more localized defense infrastructure within European countries, which was stimulative to their economy. They were hiring people, they were manufacturing, and all of that was a boom to international economies, which helped their stock prices. So that was kind of the story for international markets. I think looking forward, we would say that a lot of those trends still continue looking forward. So I think we have a positive outlook going into 2026 for international markets as well. Going to shift gears to bonds real quick. And I really just want to make the point here that bonds, comparing this is the same chart we looked at for US stocks. As you can see with bonds, they're positive more often. Looking over the last 50 years, bonds are positive about 90% of the time. 45 out of the last 50 years, bonds have had positive returns. The other thing to notice here is that bonds have, on the downside, just much lower drawdowns. It was an average drop of 3.5% versus the 14% that we saw for stocks. So that's why bonds are used as the safer component of portfolios. It's really for the protection of capital rather than the overall appreciation. So tying all that together, we've talked about US stocks, we've talked about international stocks, talked about bonds. There's some subcategories of each of these that are beyond the scope of what we can really cover today. And the purpose of highlighting the different asset classes is to emphasize the point of diversification. So the chart here is very busy, but what it is, it's color-coded with different asset classes, including some of those sub-asset classes that I mentioned. As you can see, it's very difficult to predict which asset class, which type of investment is going to do best in any given year. And you can see the leadership changes year over year. Last year, we saw emerging market equities were the top performer. Well, if you look back, they were middle of the pack last year, towards the bottom in 2023, even more towards the bottom in 2022, at the bottom. So after a bad run, but if you I just chose that one box to kind of follow along with. You can choose any box and you can follow along, and you'll see that sometimes it's a top performer, sometimes it's a bottom performer. The bottom line is it's hard to know which is going to perform best in any given year. The gray box with the line drawn through it shows what a diversified portfolio might look like. Maybe a portfolio split about 60% with stocks and about 40% with bonds. As you can see, you're getting a much smoother ride over the years. You're not getting the highest of highs, but you're also avoiding the lowest of lows. That's the benefit of diversification. And we mentioned target date funds. They're one great way of getting diversified within your 401k plan, but you can also build your own portfolio, diversified portfolio, through the list of investment options that we provide to you in your 401k. So just wanted to, again, just highlight that there's a lot more going on than just international stocks, US stocks, and bonds. So let's wrap up with a few kind of comments just on where we might go from here. This is a slide from a year ago, and I wanted to keep it in here just to make the point that this year we expect to see continued domestic and geopolitical uncertainty. The White House continues to pursue their goals in a very aggressive manner, and that means things happen quickly. We experienced the tariff announcement past April. In the coming weeks, we're going to get a ruling from the Supreme Court on the legality of those tariffs. If the tariffs are overturned, then we're inevitably going to create a lot of uncertainty over exactly how they're going to unravel them and what the impact might be to the U.S. economy, to the U.S. balance sheet, and what we might do without having that additional tariff revenue moving forward. So we think there's going to be a lot of headlines around that over the next few weeks. We also, as we've already seen this year, we have some geopolitical flare-ups in Venezuela, Iran, and Greenland being more so with Europe and NATO being concerned about, kind of the maybe some of the initiatives and the objectives for Greenland. And we continue to have the ongoing tensions with China and Russia. So geopolitical tensions are always something that's gonna pop up. But right now, I could say we're probably a little bit on the higher end with things going on around the world. So if you combine kind of all of that with the fact that we have midterm elections this year, I think there's going to be plenty of political noise that always creates a little bit of uncertainty. It's worth noting that markets typically experience more volatility in midterm election years, and we expect to see some of that same this year. If it appears that Republicans are going to potentially lose control of Congress, then the markets are going to have to struggle with what exactly the Trump administration proposals, which ones might get passed and which ones might just fall flat if there's a divided Congress and nothing can get through. And then a couple more points about next year. Here's some of the things that we're looking at in kind of the shorter term. It's just really that overall state of the economy. I mentioned earlier that we saw the unemployment rate is directionally moving up a little bit. We've seen the amount of hiring from businesses come down. It's particularly troubling for younger professionals, those just getting out of college, maybe high school kids trying to find a job. It's very, very difficult. So there's some things going on in the labor market that are impacting employment that could become concerning for the economy. But overall, we kind of see the economy in a good spot right now. It's not in a troubling spot yet, but if you look out over the horizon, I think paying attention to what happens with the labor market is going to be something to pay attention to. On the AI front, we probably would say the AI, we consider AI still to be kind of in the earlier innings. However, the ride from here could become a little bit choppier. There's been a lot of questioning about all of the spending that these large companies are doing on building out their AI infrastructure, and exactly when are they going to start to earn a return? When are they going to take all of that investments in data centers, and when is that going to start to show a return or a growth in profit for some of these companies? So we'll see if the market starts to question the profitability that these companies are going to be able to derive from their AI spending. The markets, we could see some choppiness in the markets because of that. Related to the economy, we're also going to take a look at the housing market. We have seen mortgage rates tick down here recently, and there's been some announcements from the White House about trying to put some initiatives forward to help lower mortgage rates even farther. There is an affordability kind of crisis, not only across the board right now. There's been, and it's a very populist movement, something that we've heard. The White House has taken action on mortgage rates. We also recently, in the last few days, have heard that they want to impose a 10% cap on credit card interest rates. This is all getting to helping some of the parts of the population that are struggling to find jobs, to pay higher rent prices, higher home prices. So there's a lot of initiatives to try to help with the affordability, and it's really a bipartisan issue that I think is going to be discussed a lot during the midterm elections. And exactly what those proposals are to solve the issue are going to have an impact on markets. You can just think about, you know, the impact that capping credit card rates has on credit card companies and banks alike. So it'll be important to watch how that unfolds and to see how the markets react. Micah, anything else to add before we kind of wrap up and sign off here?
You said it right, kind of, going back to the AI infrastructure, sort of, there's so much expectations and optimism kind of built into a lot of these companies and their prices. And so at some point, ultimately, the earnings side, as you mentioned, sort of NVIDIA a few slides ago, have to meet those expectations. So at some point, reality has to enter the line with expectations. So that's first and foremost on the AI side. And as you said, a couple of things you mentioned was, the Fed and cuts and certainly that the Federal Reserve, the Central Bank of the United States, has sort of this balancing act of making sure they're able to maximize employment, but also keep prices stable. And going back to 2022, one of the big issues why the markets here and abroad struggled in 2022 was inflation reached 40-year highs. And so the Federal Reserve has spent the last couple of years trying to get inflation kind of back in line. And we're currently at a much more normal level, but balancing lowering interest rates to help stimulate the economy with causing any sort of reinflation is something that could also cause some market jitters in 2026 if that does occur. So the Federal Reserve, sort of going to be a big driver of all these different themes here, and how interest rate policies ultimately kind of impact the overall state of the economy and the housing market as well.
Yeah. Yeah, thanks for that, Micah. And just to wrap up, I know we're at time here, so let's just, for more tools and resources, you can go to our website, 40wadvisors.com or 40workplace.com, and you can find some other tools and resources available to you to help you plan for your own personal future. You can also set up a meeting to talk with us one-on-one. We can set up a 30-minute time block to talk about any specific questions you have, whether it's about investing, it's about the 401k, or it's about anything you have going on in your life. So I encourage you to check out 40workplace.com, the QR code that's here. This specific QR code, I think, will take you to an investment scorecard where you can answer some questions about your investment risk tolerance, and then we can get you a report back to you that will just kind of show you how your current investment portfolio compares to how you answer those questions. So just our next, hope you'll join us in the coming months. Next month, we're going to talk about financial planning. So financial planning is kind of the broader context, with your investments being just one component of that. So want to thank you for your time. If you have any questions, please don't hesitate to reach out, and we look forward to talking to you again next month. Thank you.